If you want to understand why gold is behaving the way it is, you have to stop treating gold like a relic and start treating it like a reaction. Gold is not having a mood. Gold is answering a question, and the question is not whether the dollar disappears tomorrow. The question is whether the machine that forced the world to need dollars as urgently and as obediently as it did for the last half-century is beginning to crack in ways that matter. That is the mother line. The petrodollar was never some mystical conspiracy system. It was a very practical machine, oil priced in dollars, oil exporters receiving dollars, those exporters recycling a meaningful portion of those dollars back into dollar assets, especially U.S. debt. And in exchange, the United States providing military protection, political backing, and strategic support to the Gulf monarchies, sitting at the center of the arrangement. That machine did not make America immortal. It did make America extraordinarily privileged, because once the world must hold your currency to buy the most important commodity in the modern economy, your borrowing costs behave differently, your deficits behave differently, your imports behave differently, and your room for monetary abuse becomes much larger than it would otherwise be. That is the real story. The dollar did not become dominant just because everyone admired America. It became dominant because the world kept needing it. That is a very different kind of power. Now, the reason this matters so much today is not that someone formally tore up a treaty in front of a camera. In fact, one of the most misunderstood parts of the whole conversation is that people keep looking for one dramatic legal moment, a clean expiration date, some giant ceremonial collapse of the system. The real world almost never moves like that. Powerful systems do not usually die in one theatrical event. They weaken through changed incentives, alternative routes, and a series of decisions that each look manageable on their own until suddenly the machine no longer has the same automatic authority it once did. That is exactly what this source document is describing. The UAE stepping away from OPEC matters on the surface because it signals a fracture inside the old oil coordination system. But the deeper importance is what that move says about incentives. The UAE wants more freedom to produce. It does not want to keep acting as though the old cartel logic still serves its interests as well as it once did. And once a major player begins choosing flexibility over alignment, the old system does not collapse immediately. It simply becomes less cohesive. That matters more than people think, because the petrodollar machine was always stronger when the oil world moved together. Cracks in the oil world do not automatically end dollar dominance. They do make the old enforcement mechanism a little softer. That is the first mechanism I want you to understand. I call it the cartel fracture signal. For decades, people spoke about oil pricing and dollar settlement as though they were just part of the natural order. They were not. They were the output of aligned interests. Once the interests drift, the output changes too. And if the biggest producers increasingly want optionality, bilateral flexibility, higher production freedom, or new geopolitical balance, then currency settlement begins loosening around the edges as well. That is how systems degrade, not all at once, at the margin. This is where the second fracture becomes more important than the first currency choice. The source document points to something a lot of people still dismiss too casually. More oil is being discussed, negotiated, or actually transacted outside the old clean dollar-only framework. The UAE raising the possibility of other currencies. Saudi discussing long-term arrangements with China. India testing rupee. Linked flows. Russia obviously moving away under sanctions pressure. None of these, by themselves, dethrone the dollar. That would be too simplistic. But each one reduces the automaticity of the old arrangement. And automaticity was the magic. That is what made the dollar so powerful in the oil age. If every country on earth has to buy dollars before it can buy the energy required to run modern life, then the dollar is not just a currency, it is a toll booth, And toll booths become immensely profitable when nobody can realistically avoid the road. But once alternate roads start appearing, the toll booth does not lose relevance overnight. It loses monopoly. That is the second mechanism. I call it the monopoly fade. This is where people make one of two stupid mistakes. The first mistake is to say, the dollar is over. No, that is childish. The second mistake is to say, nothing has changed because the dollar is still dominant. That is lazy. The truth sits in the middle. The dollar is not collapsing into irrelevance. It is, however, becoming a little less unquestioned, a little less automatic, and a little more challenged at the margin. And in systems, this large margin changes matter. They matter because they change flows. They matter because they change reserve behavior. They matter because they change how central banks, exporters, and geopolitical rivals think about concentration risk. And concentration risk is really the heart of this whole story. Once Russia's reserves were frozen by the West, central banks everywhere learned the same terrifying lesson at the same time. Reserve assets are not neutral if they sit inside someone else's legal and political empire. If your national savings can be immobilized, sanctioned, or politically weaponized, then your reserves are not simply reserves. They are conditional claims. That realization changed behavior. And this brings us to the most important section of the entire source document. Not oil sales, not OPEC politics, gold. Because the third fracture is not just that some countries want to use fewer dollars in energy settlement. The third fracture is that they are increasingly choosing to store more of their actual reserve wealth in something that has no nationality, no issuer, and no direct counterparty. That is the third mechanism. I call it reserve distrust. Gold is not going vertical because the public got poetic. Gold is moving because central banks are behaving like institutions that no longer want all their national safety trapped inside the political perimeter of one currency system. That is a very serious signal. And it is one reason I always tell people to watch what central banks do, not just what they say. Central banks have spent years buying gold at a pace that should make any serious observer sit up. They are not doing that because they enjoy nostalgia. They are doing it because gold solves three problems that paper reserves increasingly do not solve cleanly. De-dollarization, debasement. Those three words are the spine of the whole thesis. Let us take them one by one. De-dollarization does not require the dollar to fail. It only requires the world to rely on it a little less aggressively than before. That alone changes long-run demand patterns. Debasement is even more direct. The United States continues to run enormous deficits, and whether those deficits are financed through direct issuance, softer real rates, inflationary drift, or other forms of quiet dilution, the conclusion is the same. Each existing dollar must live in a world where more claims are being created. Gold cannot be printed in response to fiscal stress. That is not a religious statement. It is a structural one. And diversification is perhaps the most powerful of all because it contains no apocalyptic prediction. A central bank does not need to hate the dollar to want less concentration in it. It simply needs to decide that a world of sanctions, geopolitical fragmentation, and reserve weaponization makes sole dependence look less intelligent than it used to. That is enough. That is why I do not think the correct gold thesis is the dollar goes to zero. I think the correct gold thesis is much more sober. The dollar remains extremely important. The dollar remains deeply embedded. The dollar remains difficult to replace. But the world no longer wants quite as much blind dependence on it as before. That small difference is worth a great deal. Now let us address what this means for ordinary investors, because this is where most people swing between two useless extremes. On one side, you have the gold evangelists who speak as though civilization itself begins and ends with bullion in a basement. On the other side, you have the smug dismissers who act as if gold is a barbarous relic that only paranoid people buy. I have no patience for either camp. Gold is not a full portfolio. Gold is not a joke either. It is a monetary asset that becomes more important when confidence in reserve concentration, fiat discipline, and geopolitical neutrality starts weakening. That is the adult framing. This is the fourth mechanism, I call it the institution, following principle. Retail investors often do the exact opposite of what serious capital does. They buy after euphoria and ignore what disciplined institutions accumulate quietly over long periods. Then when the move becomes obvious, they either chase it emotionally or dismiss it, because it no longer feels early. That is exactly the wrong habit. If central banks are net buyers at extraordinary levels, if reserve managers are reallocating, if the world's official institutions are telling you through their balance sheets that neutral reserve assets are regaining importance, then you should not wave that off, just because your favorite growth stock commentator finds gold boring. Boring can be very profitable. Now, I want to make one thing very clear. Following the central banks does not mean copying them blindly. A central bank has different liabilities, different time horizons, and different objectives than a household portfolio. But what it does mean is that when the most powerful monetary institutions in the world start accumulating one asset far more aggressively than before, they are probably responding to a structural shift, not a social media trend. That deserves respect. And if you are going to position around it, there are several ways to think. Physical gold is the purest direct expression. No counterparty, no balance sheet dependency. But it comes with storage, security, and inconvenience. Gold ETFs solve some of that operational hassle, though of course they introduce different structures and dependencies. Then you have gold miners, which the source document also touches on. Now here I think ordinary investors often underestimate both the opportunity and the danger. Gold miners are not gold. They are businesses with cost structures, management teams, political exposure, operating risk, labor issues, and the beautiful capacity to act like leveraged expressions of the underlying metal when conditions go well. That is why miners can offer more upside. It is also why they can disappoint people who thought they were simply buying metal with a little extra excitement. That is the fifth mechanism. I call it the leverage illusion. A miner is not just a gold price proxy. It is a business riding on top of a gold thesis. If gold rises and the miner controls costs, maintains discipline, and operates in stable jurisdictions, the upside can be extraordinary. If gold rises and the miner still makes bad capital decisions, suffers political problems, or struggles operationally, the investor learns a painful lesson about the difference between an idea and an execution vehicle. That is why I tell people to be honest about what problem they are trying to solve. If you want the monetary hedge, own the monetary hedge. If you want leveraged upside on top of the monetary hedge, understand that you just added business risk to your thesis. That is not wrong. It just needs to be named properly. Now let us come back to the dollar itself, because this is where the conversation usually becomes too dramatic or too complacent. The source document is right to say the dollar is not going away anytime soon. Of course it is not. The U.S. still has the deepest capital markets, the largest equity market, enormous institutional power, and a network effect no rival can replace cleanly. The dollar does not need to be loved to remain dominant. It only needs the alternatives to be weaker, messier, or less liquid. That is still true. But dominance and monopoly are not the same thing. And this is the sixth mechanism. I call it the cheat code fade. The petrodollar gave America something close to a systemic cheat code. The world needed dollars for energy. Then the energy dollars often came back home into U.S. debt and financial assets. That allowed more borrowing, lower financing stress, and more tolerance for fiscal excess than a normal country would ever be granted. If that cycle weakens even somewhat, then the privilege weakens somewhat too, not catastrophically, progressively. And progressive weakening is exactly the kind of thing markets misprice for a long time because it does not make enough noise all at once. That is why I find this whole subject so important. Not because I think tomorrow morning the dollar gets dethroned, because structural privilege erodes slowly, right up until people can no longer imagine it was ever as automatic as it once seemed. That is the real shift. So what should a regular investor do with a framework like this? First, stop treating gold as a fringe asset and start treating it as a serious portfolio instrument whose relevance rises when reserve confidence gets more political and more fragile. Second, stop waiting for the end of the dollar before taking the thesis seriously. You do not need the end of the dollar. You only need a weaker monopoly on global necessity. Third, understand the hierarchy: metal for monetary defense, ETFs for easier access, miners for leveraged upside if you understand the business risk. Fourth, respect that this is not only about gold, it is about what gold is telling you. If official institutions are moving toward neutral reserve assets, then you should think much harder about concentrated trust in fiat cash, long nominal bonds, and every other instrument whose value depends entirely on confidence in a monetary system staying politically clean. That is the real message. Gold is the signal. The deeper issue is trust. This is the seventh mechanism. I call it the trust meter. Gold rises not just when inflation rises. Gold rises when trust falls. Trust in the reserve regime, trust in fiscal discipline, trust in geopolitical neutrality, trust in the future purchasing power of paper claims. That is why gold can look irrational to people who keep staring only at CPI charts. They are using the wrong lens. Gold is not merely an inflation widget. It is a trust meter for the monetary order. And right now, that meter is telling you something very important. The world still uses the dollar. The world still needs the dollar. But the world is preparing more seriously than before for the possibility that needing fewer of them over time may be a smarter way to survive what comes next. That is not a headline. That is a regime shift. And the whole conversation stops being about whether OPEC broke the petrodollar in one clean move. That is too shallow. The deeper truth is that the machine is no longer as unified, automatic, and politically unquestioned as it was before. And when a machine that powerful begins to lose even a little of its old certainty, the smartest institutions do not wait for the obituary. They start moving while the public is still arguing about whether the first crack is real. That is where the opportunity lives. Not in the final collapse, in seeing the privilege fade early enough to own what rises when trust gets thinner.